Hello and welcome to the City Traders Imperium Starter Course. And we really hope it's going to be a great educational tool for you. If you're brand new, if you have a little bit of experience already, I'm sure there's going to be something to learn for everyone. So in this first part, we're going to be looking at Forex in its basic form, what it is, how it's traded, who trades it, and also the sort of mechanism behind how we actually make a profit from it, as opposed to the general way that people exchange money. So the first thing you'll notice is that Forex here is in two different colors. So why is that? Well, this word is actually standing for foreign exchange. So foreign exchange being the exchange of foreign currencies with your own currency, or of course you could be exchanging two foreign currencies together. But really it's the exchange of multiple different currencies against each other. Now let's have a look at an example of what that could be. If we think of the currencies that we're most familiar with, right, in the UK, of course, if you're not in the UK, it may be different for you, but the conversion of two currencies here, the first could be the pound. So this is the GBP, as it's known as its symbol form. And let's say we convert GBP or pound into euro or EUR, which is its symbol form. This exchange rate at the time of this recording is, in simple terms, 1.17. So that means that for every £1 you exchange for euros, you'll get €1.17 for that transaction. So of course, if you're going on holiday, that could be something that you do. If you're going to Italy, they use the euro. So before you go or when you're there, you'd need to convert some of your money into the local currency, into the euro, in order to actually spend that and obviously have a good holiday. So let's look at the opposite of that exchange rate. If you're coming from the Eurozone and you enter into the UK, or maybe you're coming from Ireland and coming into the UK, you're going to be doing the opposite side of that transaction. Or let's say you've gone on holiday, you took your euros over with you that you exchange for, that you use your pounds to exchange for before you left, and when you return, you have some left over. You then convert those euros back into your local home currency again. This exchange rate is the opposite, so it's going to be 0.85, which means that for every €1 you convert back, you get 85 pence for that transaction. So, of course, when you flip this over again, it's still the same. It's for £1, you get 1.17 euros. But then when you reverse that, it's therefore 0.85, getting 85 pence for every €1 you transact. Everyone takes part in Forex. So even if you are brand new to this, you're sort of researching Forex and what it is, it's highly likely, very, very highly likely, that you have taken part in a Forex transaction without really thinking about it or even knowing about it. So the first thing is travel or holidays, right? So if you do go abroad, you are going to be knowingly, obviously, converting your pounds into euros or wherever you're going. But even if you don't do that, a lot of people now, they just use credit cards or debit cards when they're abroad. You don't really do a sort of Forex transaction. You don't exchange your cash, so to speak, but the bank is doing it for you. So if you go on holiday and you go to a restaurant and you just tap your card on the reader, it takes like 5 seconds to do. Well, the bank is actually doing an FX transaction for you. So you are actually selling pounds and, let's say, buying euros in order to pay that merchant, but the bank is handling the transaction for you. So in that sense, you are really taking part in Forex by buying that meal from that restaurant. Purchasing goods, if you buy something from Amazon and it comes from the US, well, the person in the US that is producing or delivering those goods, they need to be paid in dollars, not in pounds. So therefore, when you buy those goods from Amazon, it's the same situation as before, where Amazon or the bank that they're using is handling that transaction for you, but you are technically taking part in Forex by doing that transaction. Sending money abroad, if some people send remittances to their family in a different country, then you are taking part in Forex there, because let's say you're working in the UK, sending money to family or friends in a different country, let's say in France, for example. Well, then it's just, again, it's a sell pound buy euro transaction for that person to then receive that money. And finally here, investment. If you want to invest in a US stock, let's say you want to buy Amazon, well, if you do that through the proper means and you actually invest in an actual stock in that company, not just like a representation of one, well, you have to undergo an FX transaction first in order to purchase that stock. So therefore, you may be selling pounds again through whatever exchange you're using. They're then exchanging that into dollars and buying a contract or buying the actual stock in that in dollars. So therefore, you're taking part in an FX transaction by investing in that stock, or even the entire stock market in terms of the S&P. However, when we're doing this, of course, all these previous points we've made, you're not really, well, you're never really doing that to try and make a profit on the actual transaction itself. So of course with investments, you're trying to make a profit on the investment, but you're not really factoring in the exchange that you're doing there when you look at those profits. So when you go on holiday, again, when you come back, you're not really looking to make money on the return of those euros back into pounds. But when we do this and when we trade, we're actually trying to make a profit from just the exchange itself. So the whole point of Forex trading, FX trading, whatever you want to call it, is to make a profit on the transaction itself. So how would this look? Is this even possible? So how do we profit from this? It's going to be the difference in the exchange rate at different times. So we know from the previous thing we looked at, the euro back to pounds, that you would receive 85 pence for every €1 that you transacted, because the euro pound rate is 0.85. Let's say that you have £850, right? So before you go to France, you exchange £850 and you receive €1,000. Therefore, you would be buying euro and selling GBP. So you're buying euro/GBP in that sense. Let's say now the rate changes, right? So when you're away, the rate changes from 0.85 to 0.90. So it's different now, because every €1 you have, you're now receiving 90 pence back instead of 85 pence back. Because remember the previous slide we looked at when it was the reverse transaction. So instead of the previous 85 pence, you've gained 5 pence on top of that for every euro you have transacted or will transact. So therefore now, if you bring those euros back into pounds again, so therefore you're doing the reverse of the initial transaction, you are now receiving £900, therefore making a profit of £50, or in percentage terms, always a great way to look at it in percentage, you've made 5.8% on that initial investment. Because let's say you are doing this for profit and not just to go on holiday. So of course this scales, the higher the figure is, the larger the profit is going to be, the smaller, but at the end of the day, it's 5.8% on that money. And that's sort of, transacting it one way, waiting for time for it to increase, and then transacting it backwards. So of course, when we are trading, we're trying to do this actively, either day to day, week to week, month to month, however you're going to be trading, and using the difference in time to make money on that transaction. And of course, it can go the other way too. You can make a loss, but of course the aim overall is to make a profit. So why trade Forex? Why not trade stocks? Why not trade any other instrument, commodities, etc.? Well, there is a huge amount of liquidity flowing through Forex. It's the second largest market in the world behind bonds, and there's $6 trillion roughly every single day flowing through Forex markets. Because of course, this isn't just trading activity, this is also the purchase of goods, it's holiday money, it's just everything, it's the flow of money in general. So it's an extremely liquid market, meaning that you can enter, exit, trade whenever you want, not really going to have any problems at all. More advanced versions of that we'll get to later, but it's a very, very liquid market. So of course, stocks are still very liquid, but they're not as liquid as this. One huge advantage of Forex is it's open 24 hours a day, 5 days a week. So starting from 10 p.m. on a Sunday, of course thinking of GMT UK time, to 10 p.m. on a Friday, it's open all of those hours in between. So therefore, if you're trading at 3 o'clock in the morning, or you're trading at 9 o'clock in the morning, it doesn't matter, it's the same. It's always open. And let's say that you're in Japan, you can trade in your daytime, and if you're in the UK, you can trade in your daytime. There is no restriction on that. Of course, there's going to be different movements in different times of the day, but it's always open during those 5 days of the week. So it's very accessible to anyone with different work conditions or commitments that you have. It's very, very viable and open to anyone. You don't need a huge upfront capital, right? So if people assume when they trade, if they're buying a stock or something, that you need huge amounts of money to make a profit. Well, with Forex, it's not like that at all. And again, like the previous thing, we're going to get to more of this in depth later, but it doesn't require a huge upfront capital deposit to actually trade this. And on top of that, you don't even have to trade your own money, because there is also the option of trading with funding, where you actually receive funding from a company or from someone else, and you trade that in an attempt to make a profit on top of that. There is technically unlimited upside potential, because as I said, you can scale this, right? So let's say you start with £1,000. There's potential for profit there, but But then if you scale that to 10,000, to 100,000, to a million, the percentage figure stays the same. So let's say you make 5% a month on £1,000. Obviously that's quite small. But if you can scale that up and up and up, there's technically unlimited upside potential, because 5.8% on £1 million is quite a lot. So of course, there's a limited upside potential for the profit, but then the larger you go, obviously the larger potential loss too, which is why you need to manage your risk very well, which we're going to get to later in the course. But it's definitely possible. So very, very high upside potential for income and for profit. So finally, let's look at who takes part in the Forex markets, who takes part in trading this and also influencing the market. And if we bring up this pie chart here, it's going to give us a rough kind of guide as to who's in this market. So the first thing I want to start with actually is top left there with retail traders. So a retail trader is you, it's me, it's anyone that takes part in FX, where you're trading with your own capital and you're trying to make a profit for yourself. So you're not taking investment from someone, you're not working for a bank, you're not sort of trading, with banks' money. So it's really just the individuals who are involved in the market for themselves, trying to make a profit and trading sort of day to day like that. So retail traders, we do make up the smallest slice of the pie because of course there's many of us, but the amounts of money we trade with are not very much. Because if we move to like a hedge fund, for example, there on the left hand side, let's say that I have £100,000 in my account. It's quite a lot of money to the average person, but to a hedge fund, £100,000 is absolutely nothing because they may have £1 billion. So you see the difference, it's quite large. So retail traders, if there's a million of them with 100,000, that's quite a lot of money together, but still it pales in comparison to these other slices of the pie. So let's start on the right hand side then. We'll go on to the next one, which is central and commercial banks. Now, commercial banks are going to be your HSBC, Barclays, all these large high street banks. So these guys do trade Forex. They do mainly facilitate transactions though. So like I said, when you're abroad and you buy with your card that meal from the restaurant, the commercial bank are going to be the ones who deal with the transaction. So they convert the currency for you and pay the merchant. These commercial banks, they also take part in their interbank trading. So they trade with each other. They take what's called a spread, so they take a small fee from the transactions that you do. And they also have their own trading desks. So when they use the profits they make and the money they have to try and make a profit by actually trading the markets themselves. Now, central banks are slightly different. They're like the Bank of England, the Federal Reserve, the European Central Bank. These guys don't necessarily trade Forex in that way, but they do have a ginormous influence on the market. And at the end of the day, they are the backstop of everything. They are the original liquidity, the original money point where all the money gets printed to and created and managed, right? The next one, investment banks. So you can think of JP Morgan, Goldman Sachs, you've probably all heard of them. Very, very similar to commercial banks in a way. These guys are facilitating transactions, maybe facilitating like a merger or an acquisition of a company where, let's say a US company is acquiring a European company for $2 billion. Well, they need to actually buy them out in euros because of course you can't spend the dollars in the euro, in the Eurozone. So therefore they're taking part, facilitating that transaction that could be huge. They're also trading themselves with their own funds, their own desks, where they are actively trying to make a profit in the same way as a retail trader is, but just with an astronomically larger sum to make a profit in the market. So finally we have hedge funds, similar prospect again, where they are taking investment from a variety of sources and they are using that money to trade out actively with their desks in order to make a profit on that money. So there's a lot of players in this market. Of course, everyone has their own slice of the pie, but we all contribute to that ginormous $6 trillion almost figure a day. And of course, you could also add into this the people who do it without knowing. So those buying products and also manufacturers, etc., and people spending money on holiday. So that's a brief introduction into Forex, and that's a brief introduction there as to who is involved in it.